The gas world is heating up, and not in a good way. The European Union is struggling with its worst energy crisis yet, and the stakes couldn't be higher. Qatar is dropping threats about cutting off its gas supply. Russia's pipelines have gone eerily quiet, and the US seems ready to shake up the whole game. So, how did we end up in this energy tug-of-war? After Russia invaded Ukraine, Europe worked hard to relieve itself of Russian energy. Qatar comes in as a vital supplier of liquefied natural gas, LNG, to Europe. But with the new EU law imposing tough sustainability and reporting rules, Qatar is not too thrilled. Experts believe this could embolden other energy giants to push back against Europe's tough regulations. And then there's the US President-elect Donald Trump, taking a hardball approach. He has made it clear, if the EU doesn't start closing its $131.3 billion trade gap with the US by buying more American oil and gas, tariffs could be on the table. So the big question is, how messy can this get? Let's just say, the energy world might be in for a bumpy ride. Back in 1997, Qatar shipped its very first batch of LNG to Spain. Fast forward just 10 years, and it has become the world's largest LNG exporter. How did they do it? This meteoric rise was fueled by the development of the North Field, the world's largest non-associated gas field. Today, Qatar still plays a massive role, accounting for over 30% of global LNG exports. In April 2022 alone, Qatar exported over 7.5 million metric tons of LNG, surpassing even the US, according to Bloomberg data. Although now the world's third largest exporter of LNG behind the US and Australia, Qatar remains a major player in the energy sector. Now Europe has been leaning heavily on Qatar for its gas, especially after cutting ties with Russian energy due to the war in Ukraine. Over the last 3 years, Qatar has supplied about 12 to 14% of Europe's LNG, sending over 37 million metric tons of gas during that time. Why? Europe needed a plan B after turning its back on Russian pipelines. To make up for the loss of Russian gas, the EU signed long-term deals with Qatar. These include agreements with Shell, Eni, and Total Energies for a whopping 3.5 million tons of LNG annually for 27 years. These deals are big. European giants like Shell and Total Energies have committed to importing millions of tons of Qatari LNG each year. Plus, Qatar is expanding its gas projects, set to boost production by 2026 or 2027. So, Europe has been banking on Qatar to help keep the lights on. But here's where the plot thickens. Europe has introduced a new law called the Corporate Sustainability Due Diligence Directive. Starting July 2024, this law requires big companies doing business in Europe to follow strict rules on human rights and environmental protection. It's like a checklist to make sure businesses aren't harming people or the planet, not just in their own operations, but throughout their entire supply chain. If companies don't comply, they face heavy fines of up to 5% of their global revenue. For a giant like Qatar Energy, that's a huge deal. You're losing 5% of the money that funds your entire country. Naturally, Qatar isn't too happy. Qatar Energy's CEO, Saad Al-Kaabi, didn't mince words. He said, "If I lose 5% of my revenue by selling gas to Europe, I just won't sell to Europe. I'm not bluffing." To put it simply, Qatar sees this as a deal breaker. Al-Kaabi made it clear that this isn't just about business. It's about the money that supports Qatar's entire economy. But Europe's energy worries don't stop with Qatar. US President-elect Donald Trump has his own demands. Trump is pressuring the European Union to buy more American oil and gas, threatening tariffs if they don't play along. And knowing Trump's style, he's not bluffing either. On his Truth Social account, Trump called out the EU directly, saying, they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Otherwise, it is tariffs all the way. If you're wondering why Trump's making such a big deal, it's about trade. The US runs a significant trade deficit with the EU, which is over $156 billion in goods, and Trump has been railing against it for years. Energy is one area where the US has a clear advantage, making significant waves in the global energy market. In 2023, combined US exports of crude oil and petroleum products hit a record of approximately 10.2 million barrels per day, marking a 6.6% increase from the previous year. Crude oil accounted for about 40% of these exports, while petroleum products like gasoline, diesel, and jet fuel made up the remaining 60%. Why the increase? It started when the EU decided to phase out Russian energy after the Ukraine invasion. But Europe may have already hit its limit on how much US oil it can import, so Trump's push for large-scale purchases could hit a wall. The EU isn't ignoring Trump's threats. European Commission spokesperson Olaf Gill pointed out that trade between the US and EU is more balanced than Trump claims. While the EU has a trade surplus in goods, the US has a big surplus in services and energy. Gill also emphasized the EU's commitment to diversifying its energy sources and reducing Russian imports. He said the EU is open to discussions with Trump about strengthening ties in the energy sector. But let's not forget that these are the same leaders who've been vocal about moving toward cleaner energy. Balancing sustainability goals with Trump's demands for more fossil fuel purchases won't be easy. When it comes to LNG, Qatar has a clear edge. Their LNG is generally cheaper than what you'd get from major players like the US or Australia. Why? Two big reasons: abundant natural gas reserves and cheap labor. These factors mean lower production and transportation costs, which translates to lower prices for buyers. For context, we're talking $2 to $4 per unit. Compare that to the US at around $8, or Australia at a whopping $10. But the thing is, the US still maintains its position as the world's largest LNG exporter, with a staggering 93 million metric tons per year of export capacity as of September 2024. The conversation around US energy exports isn't just about economics. It's also deeply tied to politics. Donald Trump, who has consistently been against trade deficits, sees energy exports as a way to rebalance trade. Trump argues that trade deficits hurt the economy very badly, blaming horrible deals with countries like Mexico and South Korea for flooding the US with cheap imports that have led to factory closures and job losses. However, not everyone agrees that trade deficits are the villain here. Some economists argue that a trade deficit can actually signal a strong economy, as it often reflects higher consumer spending and investment. For instance, when the US economy is booming, people import more goods, and higher interest rates make the country attractive to foreign investors. In that sense, the trade deficit isn't necessarily a crisis, it's a side effect of America's economic strength. But hold on, let's zoom out and look at the bigger picture here. The global energy landscape is shifting, and one major player making bold moves is Saudi Arabia, which has significantly increased its purchases of oil products from Russia. Saudi Arabia has become the biggest buyer of Russian fuel oil and something called VGO, a type of oil used in refining. In November, Saudi imports of these products surged by 29% compared to October, reaching 0.85 million tons, according to traders and LSEG data. This spike coincides with Russian exports of fuel oil and VGO climbing to 4.2 million metric tons, a 6% increase from the previous month. Since the European Union imposed an embargo on Russian oil products in February 2023, Asia has become the primary market for Russia's fuel oil and VGO. While India and China remain major buyers of Russian oil products, their imports dropped in November. India's by 5% to 0.47 million tons, and China's by 25% to 0.32 million tons. For China, this decline might be linked to an anticipated tax overhaul that could make imports pricier. Meanwhile, Singapore, the world's largest bunkering hub, is set to receive about 0.6 million tons of Russian oil products, though some of these shipments may end up at Chinese ports. Why is Saudi Arabia buying Russian oil? Think of Saudi Arabia as a savvy shopper. With fewer buyers, Russia is offering oil products at a discount, and Saudi Arabia is seizing the opportunity. They're using this cheaper oil to fuel their refineries or even re-exporting it. It's like buying ingredients on sale and selling a gourmet cake at full price. Saudi Arabia is also acting as a middleman. By absorbing Russian oil, they help Russia offload surplus while stabilizing global oil prices. For now, this strategy lets Russia bypass the EU embargo and find new markets, keeping its revenues flowing. However, this dynamic could shift quickly as Europe faces higher prices from seeking alternative suppliers and global demand fluctuates. China and India have been major buyers of Russian oil this year, but November saw a slowdown. China is preparing for new taxes that could raise import costs, while India seems to be waiting for better deals. Meanwhile, Singapore has stepped in, receiving Russian oil, with some shipments possibly heading to China later. This reshuffling keeps Russia's oil business afloat while potentially impacting global fuel and heating prices. The EU, meanwhile, is pushing hard on renewables. By 2030, They aim for 42.5% of energy from clean sources like solar and wind. In 2023, renewables already accounted for 44.7% of their electricity, a solid step forward under the European Green Deal. The plan aims for net zero emissions while proving economic growth can happen without heavy reliance on fossil fuels. However, challenges remain. The EU still imports 60% of its energy, which means that while they have reduced reliance on Russian gas, they remain heavily dependent on other suppliers. Renewables, while promising, can struggle in peak demand seasons, like winter. High energy costs, inflation, and public debt also complicate the transition. Price caps, while helpful short-term, could deter renewable energy investments. Cross-border energy networks, though essential, carry risks. What happens if one country refuses to share during a crisis? With all these said, it seems the EU has a lot on its hands. If Qatar cuts its LNG supply to the EU, the big winner would be American energy companies. With Europe scrambling for alternatives, they'd likely turn to the US for LNG, giving American companies a huge payday. And since Europe would have no choice but to buy from them, it creates what's called a captive market. Basically, Europe is stuck paying higher prices because it has fewer options. Some say this could be the beginning of a bigger shift, but there are still some challenges. High energy prices make it really expensive to manufacture goods in Europe. That could push businesses and investors to look elsewhere, hurting the EU's economy in the process. It's like scoring an own goal in soccer. Policies that end up hurting yourself more than helping. And if energy costs don't come down soon, it might make Europe a less attractive place to do business. So, what do you think? Can Europe find a way out of this energy mess? Let us know your thoughts in the comments below. And don't forget to hit like and notification bell so you don't miss future videos. See you in the next one.